Hello and good morning. Welcome to the show, The Weekly Jargon. I am Jose Rodriguez.
And Rohi Zachariah.
And today, Rohi, we got a show talking about how cities in California are doing budget-wise, right? So we'll kind of dive into some of the cities here in California, what's going on with today's economy, how are they doing. We'll touch on ours. So if you like a good show, stick around. We're going to go ahead and get you guys going. But meanwhile, we'll do what we do always is we'll go ahead and try to break some ice by answering a question from our question box. And this is a random question that we do. So if this is the first time you're joining us, we just ask a random question. If you'd like, please follow us, share, and share your comments so that we can tally these up and see where we left off. So the question today, Rohi, is what level of care is too much for an everyday piece of clothing?
I think this is a whole topic in itself if we wanted to. But it always reminds me because when my wife goes through my closet every once in a while, I'll always ask her about, some favorite shirt that I had. And she'll be like, you've had that thing for 20 years. I got rid of it, And in my opinion, I always be like, hey, it was still good. Like the letterings were good. It still fit me, But for her, she was tired of it. She was ready to make space for a new one. So I think in regards to the care, like how bad does it have to get? I will say, my mind always goes to like my underwear, because it's like when that elastic has given out and it just doesn't even hang on anymore. All right, it's time to let it go. But I think when it comes to general clothing, like jeans get more valuable the more tears they get, and I feel the same way maybe with the shirt, like. You can buy a pair of jeans that has like fake mud stains on it, and so I think it would depend on the article of clothing, but I would say definitely my hard line there is when it comes to like my underwear, and it's just no longer functional.
Yeah,
it's time to just let it go.
Well, I don't think you're alone on that there, Rohi. I think,
I hope not.
and sometimes I pose a question if this may be more of a gender, the difference between the gender, right?
Yeah.
Because you mentioned something, right? Like with jeans, the more they wear out, the more you want to keep them because for some reason, they mold to you, right? And I'm sure for some women, it's no different. I mean, when they like wearing certain snug jeans, I mean, obviously they're going to utilize that for fashion or for comfort, right? And for me, shoes are very important to me. For so many years, I just wanted to buy shoes that were inexpensive.
Yeah.
But I quickly learned. Well, I can't say that I quickly learned. It took me some time to learn that sometimes you get what you pay for. Mm-hmm. And when it comes to shoes, you're going to be on your feet for many hours throughout the day, and there's nothing like having a nice pair of shoes that are going to be comfortable. Mm-hmm. So at times, I would wear these shoes that were made with synthetic leather or some cheap material, and frankly, I didn't think they were very comfortable. They wouldn't last long, and they weren't as comfortable. They look good, but it wasn't. I wasn't after the look. Maybe during my earlier years I did, but now it's more about how do I get a shoe that just is molded to my feet and I feel very comfortable. And sometimes those are leather shoes, and I don't mind spending that extra dollar, but they'll last longer. And to the question, what level of care? I mean, I'm wanting to make sure I keep them as long, especially when they've molded to my feet, when I've kind of broken them in. And now I've conditioned them to my standards, and it's hard for me to let go of that. So the care, I'd love to care for them as long. And clothing, no different. I keep them for a long time. I think it may be different for genders, but again, if you have a comment, let us know. Again, the question was, what level of care is too much for an everyday piece of clothing? With that, we'll start going to our topic in hand is budgets, right? Yeah. And we see this with many cities now facing some budgetary issues, right? Well, luckily here in the city of Madera, it looks like we have a balanced budget, and, and this is what we got in our last meeting. Again, if you are keeping in tune with Madera, we will have a meeting this afternoon, and this is in regards to our capital improvements. So if you like to have priorities in certain improvements or projects that we do around the city, this would be a good meeting to attend so you can voice your opinion and voice your concerns regarding projects, whether they be sidewalks, parks, anything that's got to do with public works and or projects that are in the lineup, this is where you would come in and advocate for your priorities. But we will also run through and refresher on our budget, and we should have a balanced budget by the end of the month, because we're due to have that. That's our fiscal year runs from July 1st to June 30th. But anyhow, Roy, talk to me about some cities that you're hearing about, and let us know what these cities are facing now.
Yeah, so I mean, we're looking at, it's obviously a lot of the bigger cities right now, but, LA, San Diego, San Francisco, Oakland, Sacramento, San Jose, Fresno, which is our neighbors, and Berkeley facing some of them, a couple million, which is 20 million for Fresno, up to $1 billion for Los Angeles, which obviously it sounds a lot, and it is a lot for a large city. I mean, if you have any kind of reduction of money's coming in, it's going to be on a much grander scale. But Fresno just approved their budget last night, $2.3 billion. Sorry on that one, and kind of glancing through it. There's some big reductions proposed, and even with that deficit, obviously, I'm sure they're still going to be in trouble, and they're going to have to cut even more. But I think, for us, when we go through these, these meetings over the next couple of weeks and looking at our budget, I know Madera has, I think, fared well as a city as far as our spending, but looking to our neighbors, I think we have to have that over our shoulder just to kind of make sure we don't get into a comfort zone, knowing that, like the caution I brought at our last meeting, which is, we're seeing it in our side, the slowing of the economy. I won't say quite crisis or like recession or depression or whatever words you want to use, but I think, when you look back to a 2019, budget, I think that's kind of where we have to go back, is saying, forget the COVID years, I hate to say, and go back to 2019, and let's imagine the last 4 years just didn't happen, to kind of figure out, did we grow or did we shrink? So,
that's a good assessment there, Rohi, because when we look at 2019 levels, I think you go back and see how the economy was doing, and towards the tail end of 2019, there were some shocking events that created some volatility in our markets as well. And coincidentally, a big pandemic that came about, people can put on the tinfoil hat and what have you. I mean, you can call it whatever you want. But obviously, these particular events, spark whether we have to do some type of quantitative easing and what have you. We saw that through the pandemic, right? We saw a big flood of money coming to a lot of municipalities, to folks, stimulus, PPE packages. I mean, there was, you name it, a lot of money, trillions of dollars being dropped into these economies because of the pandemic that took place. That created, just a lot of money and expansion of the currency. And today, I think we're starting to see the effects of that, right? And we're starting to see, the high is over, and now it's time to get back to where you were at. And the sad thing is that you are starting to see a lot of municipalities within not only the state of California, I'm sure within the country, that are going to be facing these budgetary issues. When we talk about budget, though, Roy, I want to just expand a bit how government budgeting versus your budget at home and my budget at home, right? And I think it's a very simple concept, right? I mean, you have monies coming in, and with revenues coming in, you also have your fixed monthly expenses. I believe where we get in trouble individually, and again, this is where we know the amount of revenue coming in, and we know the amount of expenses, but yet we just can't cover the expenses. So we go out and we borrow, right? And it's become very easy for us as individuals to go out and acquire debt, acquire credit cards, acquire something on credit, knowing that our income may not support it. But it's allowed, right? I mean, that's the flexibility we have here in this nation, is that credit could be easily available. And when shit hits the fan, or excuse my language, things tightened up.
Yeah.
Right now, hey, you're losing hours, you're losing maybe jobs. Now it's time to pay. And when you can't pay, that's when you face these budgetary issues. So when we bring it in a bigger scale with municipalities, it's no different, right? Municipalities gather funds from all these sources, right? We talked about it in our budget workshop last week. Is you have your taxes, right? And that's divided into 4 or 5 different taxes. You have your sales tax, property tax, DMV tax, registrations, and what have you, permits. All those funds come to the general fund, and then you have all these expenses. You have to pay people to operate. You have to pay for services.
Yeah.
And before you know it, do you have sufficient revenues to cover your expenses?
Yeah, and I think the difficulty, I would say, like you're saying, going back to like personal finance and governmental finance, I think it's, coming in as I'm the new guy on the block in the government side, but I think that's where it's somewhat frustrating because, yes, on the personal side, as long as there's no major shift, like I don't lose my job, I don't, you're not going to really see, you can't get necessarily a pay reduction in the sense of like an hourly rate. So as long as my job is secure, which I think most people's jobs at this point are, you kind of, like you said, you already know the yearly budget. Like you could easily, if you wanted to, in a fine, a granular scale, say like, this is what we're going to make either on a single, double income, whatever. Here's our budget for the year. And, here's our major, you could do a total breakdown. And I would like to think minus the mishaps that may happen, like car breaking down, somebody gets hurt, somebody gets sick. I still think you could have a pretty easy balanced budget. I think you should be able, and then maybe have that reserve amount, like everything you would do in a city. And I would like to think that by the end of the year, whatever your fiscal year wanted to be, that if you were really, diligent with it and disciplined, I think you could do it. I think the average person could do it. I think the difficulty when it comes to the government side is knowing the inability to predict, because again, we don't know what people are going to spend next year. This July through next June, we don't know if people's spending is going to go down. Are they going to go up? It's a crystal ball, and it doesn't matter what you pay a financial person or company or whatever to give you a projection. It's all a guess. Nobody could guess in 2019 that 2020 was going to have COVID happen. Or how the economy was going to react. It's so. I would always say, I would, as a government side, take extra caution. I would allow extra reserves just because of that. And then at the end of the year, if there's leftover, use that to kind of build up for those rainy days, which I know we kind of have to some degree. But I think when we look at some of these cities, when they face these huge deficits, it's like you couldn't see that coming. Like you couldn't.
Yeah, and I think that just kind of speaks to the level of, I would say, projections, right? Did you not have?
But is it reckless? I'm saying, you can have a projection all you want, but was it reckless?
And I think the bigger the deficit, you must have the bigger the general fund, right? Like for example, we look at LA, $1 billion. That's a lot.
Yeah.
But their budget is also huge, right?
Correct.
But maybe for them, it's $1 billion is $1 billion, really. It's like me saying, hey, at the end of the day, I spent more than $10,000 of revenues that I had. So I'm in the whole $10,000 personal, individually, right? The way I look at it, well, where am I going to get that money? Well, you're going to have to carry that. And that's what happens with a lot of our individual debt, is that we carry it for financing opportunities that are done for many years. We do this with our mortgage. We do this with our vehicles. We do this with credit cards. And at times it's a sea of debt that sometimes it's hard to get out of. And although you try to get out of that debt, it's hard not to be impulsive to say, well, I can't take on that recreational boat that's $110,000 right off the top.
Yeah.
But I know that I can chop it down over a period of 7-8 years. Yeah. Now, may cost me 110. I'll have to pay 160 for it, right? That's the price you pay, and that's the I believe the incentive for these lenders to say, here's the money.
Sure.
And no different with mortgages, right? You can get a mortgage today for 7%, but expect to pay twice as much when you're done paying that full payment if you stayed at that 7%. Now, with municipalities, what I do feel that may have occurred is that all that flush of money that came in, they flushed them with cash through the one-time relief that
Yeah.
they had, right? I
Yeah.
mean, municipalities may have utilized that one-time funding as, hey, let me acquire more personnel, whether it be in law enforcement, public safety, whatever departments that needed to be alleviated or needed additional personnel, then you stuff that money there,
Yeah.
but not knowing that that was a recurring expense. And when it's a recurring expense, then at the end of the year next year, you may not have enough and you may have to dip into your reserve fund to pay for that. Before you know it, 3-4 years down the road, hey, I'm facing a deficit.
Yeah.
Well, I think we do have to be a little scrappy in that you have to go back to those levels of where you were maybe in 2019 prior to that flush of cash, and maybe start looking at it that way. Yes, everything's become more expensive. Inflation has become obviously a big factor here because more people demand more money as the cost of living continues to go up. So in order to keep employees and retain them, you have to be able to provide them a level of compensation that equals to the standard of living, or else they're going to be looking for areas. And here's what I think did happen. During this time, a lot of the municipalities, especially surrounding us, and I'm not specifically saying Fresno or anybody, but municipalities around the Central Valley were competing for your top professionals, whether it be in law enforcement or department heads, and you offered them a bit more money because you needed to attract and
talent.
retain talent.
Yeah.
Not knowing that it could potentially come back if you don't have the levels of revenues that you need in order to keep them.
Yeah.
And I think at the end of the day, you have to come, and again, with inflation, because you do have to keep up not only for your entire staff, but one thing I could say about Madera, especially since I've been on the council, is that we've been pretty balanced. We've kept a pretty well healthy reserve balance. Not to say that Madera is the exception. I'm just saying in general, I think it goes to how the council directs, hey, can we afford this? And having a city manager that understands budget and understands, hey, do you want to be on the front page of the newspaper knowing that you were negligent and not knowing that this could happen?
Yeah.
And you have to. I mean, it doesn't matter. There's going to be great years. Cycles of the economy tell you. There's going to be years where the economy is doing well, and then we start hitting recessions, and then you have to be prepared for that.
Yeah.
And it's no different than the individual. They always tell you, make sure you have money saved at home or you have a reserve balance in case you run into some issues.
Yeah.
And although they tell you 3 months, I always think it's better to have 1 year.
Yeah, I mean, and again, I think the difficulty with a lot of those statements comes from running a business and understanding I guess how to run a business, and it's looking at and that's what the argument, that it's no poke to anybody in particular, but that's always the argument when the issue is, well, pay more and you get better. Coming from like our industry, and I think coming from industries that I hear about in general, it's not really the case. I mean, if I have a manufacturing company and we're short on staff and we need to hire people, we don't necessarily go looking around the pool and say, well, company B across the street is paying 30, so we got to pay 33 to get their people or better people. You just put out what you can afford. If we can only afford to pay 20, you can only afford to pay 20. Now, obviously people are going to apply, and yes, maybe the level of employees or people coming in, applicants, isn't going to quite meet what you want, right? You may be wanting this really skilled 10 years experience person, but you're going to get the guy that a high school dropout, maybe just got their GED, but he's looking for a job, and you may have to hire 10 of those to weed out to find that one that's the up and coming, right? That's what we see. I mean, we do pay above minimum wage, and we do pay, I would say, above the average in our area, and we've always struggled with the same thing. But at the same time, I know if I offered, let's say, instead of maybe $17, $18 an hour, if we said in a crazy thing, say, I'm going to pay 25, you're not going to see the level, like it's the same pool of people. You're not going to see all of a sudden like 20-year experienced professionals coming out of the woodworks. It's going to be the same people. You're just paying them more.
Yeah.
You know, so that again, that's the difficult part. That's where I always argue with some of those to say, you know, when we're struggling to fill positions at the city or any level, it goes back to, I think, a fundamental issue, which I think I've said before, which is people don't go to school to tell themselves, I'm going to go work in city. Like, I'm going to become a city engineer, or I'm going to go be a city manager. Like, I think it's a sidestep. I mean, they maybe go into finance or they go into engineering. Maybe they work for a firm for a little while, and then there's a position open that they say, hey, I think I might like that. But I think, you know, when you talk about where the schools and where a lot of, you know, the issues arise is that why isn't there a class to say, here's city government? You know, like we talked about before, like here's what a city council person is. Let's go play city council, or let's, you know, in having those like summer internships, bring in these young kids that are maybe in high school or in college that maybe, all right, hey, this kid's got some talent. Maybe we give him a little extra, you know, schooling, maybe help him with the schooling, and he joins our team. And then you build him up into that person you want, but not having to say, look, we can't find anybody. Fresno's paying $300,000, so we're going to pay $350. $350 for what? You know, I don't know. It's just, if you can't afford it, you can't afford it.
And it seems to be a race to the top, right?
Yeah,
Who can
100%.
get there first? And
Yeah.
sometimes that does create some budgetary issues. You know, I think we face a conundrum when it comes to individual finance and municipality finance. And the reason why I say that is because, you know, with municipal finance or budgets, you don't necessarily have all those revenues up front. It takes, you know, months for you. Sometimes it's deferred revenues that come in late in the game, right?
Yeah.
You are projecting that this is the amount of money, no different than any other business. The problem with the business and the municipalities is that, like you said, you can make sudden cuts in a business knowing that, hey, I'm not going to be able to operate next month.
Yeah.
I need to make immediate action to resolve this here. I have to do whatever it takes, and that's what becomes versatile. You know, you're very flexible in the way you can spend your money. Say, I can't buy this today. I can't get this today. And sometimes with municipalities, it's harder to do that. You'd have to go through a full process, you know, vetting that out, being transparent, having councils approve here or there, you know, to make decisions. And that in itself can take anywhere from 6 months to a year. By that time, you may be running that deficit. And I think that's where, you know, that's the difference between those areas of individual and or municipalities. And the fact that, you know, you run it somewhat like a corporation, although it's a nonprofit, you're still running it, and you have a responsibility, a fiduciary responsibility to make sure that the tax dollars are being well spent. And I think, how do you tell taxpayers that, hey, you're running a deficit of $20 million, $1 billion, or even $1 million?
Yeah.
I mean, how do you tell your residents that? What needs to take place for us to bring that back to a balanced budget? And a lot of the times, the only way that I see that happening is it's always done with personnel.
Yeah.
I mean, you can't take away services. I mean, so you have to reduce personnel. And the majority of municipalities, especially in California, they're very heavy because we want safety. It's public safety. And this is nothing on public safety. I'm just saying in general, you're going to see these general funds that are heavily weighted on public safety because we need fire protection and we need police protection. And people feel safe around their communities when you have both. So you're going to require to fund those a bit more. And part of your general fund, at least half of your general fund, will be allocated to some of those public safety. Now, that being said, you know, where you face issues is where you overstaff because you may have received these one-time funds, you overstaff, and boom, there you go. And that's kind of some of the issues that I see that take place. So when it comes to reducing and trying to balance that, the one thing they go for is, well, we have to furlough, we have to certain vacancies that we can no longer fill, and then we may have to lay off.
Yeah.
Nobody wants to hear layoffs, but you look at the hospital, for example, that took place back in 2023. They're a business. They're subject to any other laws of economics. They're going to have to pay the piper
Yeah.
if you're not running a very smooth operation. COVID happened. They ran up their costs. Hey, I don't have money, whether it's the state's reimbursement rates, whatever you want to call it, just couldn't do it.
Yeah. Let me show. I mean, this chart I think is. This is where I know it's a poke at your industry. This is the housing market,
Yes.
And this is coming from only the 60s through 2020. So you got about 60 years. The important part is always that there's the ups and downs, and that's always been an argument and why it always bugs me when they say buy now. It's buy now, hold on to it. It's because.
Take the rate. What is it? Marry the house. Take the rate. Oh, man, I hate that.
hate
term.
that. So
I hate that term.
this chart here that you're looking at. I mean, when you talk about predictability, if there was only one blip, I'd say okay, look, there was a blip, but there's a blip almost period. I mean, you could almost pin when the next one is coming, and I hate to say the next one is probably coming based off of this, And why I say that, in the gun industry, we have the same thing. We don't have fancy people that are following the charts, but somebody that I knew that was in the industry for a lot longer than I have been, he said the same thing. You can put it on your calendar that every 8 to 12 years, guess why? Because presidential elections, there's always this major event that shifts the industry. And, obviously for us, we want to know when the next spike is going to be, so we load up, sell everything at a huge rate, and then know, like right now, where we're in a decline, maybe be a little thin and kind of, ready for the next thing to come around. But that, I mean, that's the kind of stuff when we look at budgetary that it makes it difficult, because even if we know, maybe we have that crystal ball to say, hey, look, we're within that danger zone of a recession or depression or whatever you want to call it, we're so locked into like pay rates. Like you can't say, well, guess what? We're going to have to reduce pay by 30%. You just can't do that, right? So like you said, to your point, yeah, you have to reduce staff. But to what point? How far can you go to a skeleton crew to where now services are affected, right? There's a certain level. And I think that's where cities, again, get themselves into that deficit issue. You're going to have to keep a certain level of services available, a certain amount of people available to keep the city running. But knowing that, again, if we're in this recession and funds are not coming in like they should, what do you do? And I know, again, on the personal side, that's where the 2008 or whatever, date you want to put it, unfortunately, people have to take a loss,
And I have to agree to that, because those cycles of our economy or those cycles of recessions that you see there, Rohi, are very important indicators as to what you can anticipate. And unfortunately, your average consumer this isn't something that's presented to them, again, in high school or even after high school. Or, you can have doctors out there that don't know. I mean, they study a specific skill set, and, their thing is, well, I'm going to try to make as much money. And sometimes these cycles don't affect them, so to speak, right? Because, people are getting sick every day, right? No different than that barber, right?
Yeah.
You got to get a haircut. You may let your hair grow a little longer and go less frequently, but you're still going to go get a haircut.
Yeah.
And that's kind of when I see it. When I'm starting to let my hair grow longer, just a little bit longer than normal, I'm going 3 weeks instead of 2 weeks to visit my barber. Then that tells me, hey, maybe I got to cut back a little bit. And that's my indicator that, it's the economy isn't really providing to the extent that it has before. So I have to scale back, and I have to start making those adjustments. Because the lifestyle that we carry, it's very hard to go back.
Yeah.
Once you get used to having a lifestyle of going out every week, spending this much money out at wherever you're at, whether you like to drink, party, whatever the case may be, you like to vacation, you'll know. And if you're blind not to see that it's creating a deficit, then you're gonna have a problem.
Yeah.
And those problems are linked to those cycles that you presented earlier. They're going to go up and they're going to come down. Yeah. And you should be ready, because when it comes down, there's opportunity.
Correct. Yeah, exactly.
You know what I'm saying?
Exactly.
And this is the thing with the housing. You know, me being in the industry for 24 years now, I mean, I see it. I see it very clearly. And it's hard for me to say, I mean, I can bring flares like they do with planes and say, don't, you can't come in this runway. You cannot come in this runway.
Yeah.
Please do not.
Yeah.
I mean, but I can't verbally tell them that.
Yeah.
You can only see and you can only guide. And that's what we're there. We're there to guide you.
Yeah.
And we're there to provide you with an honest opinion as far as where you're at. Obviously, the underwriters and/or the systems that crunch these numbers, they tell you whether or not your risk is tolerable or not. And most of the time, you'd be surprised how much they tolerate.
Well,
And for me, those are levels. Those
Yeah.
are levels of default levels of failure. But
Yeah.
yet, we can and we do push because without those levels of failure, we don't have these dips in the economy where, oh shit, now these folks that were possibly probability of default are actually handing over their and they've lost all this money. You know, I mean, it's hard
which
to see.
I would argue is by design. I mean, because again,
Well, of
when
course.
2008 happened, we had all this talk, oh, the industry is going to tighten up and we're not going to allow the craziness, the easy lending of money. And then you go back to the last couple of years and it's kind of like, oh, you make $20,000 a year. You can buy a $1 million home. Who cares? You know, paid over 60 years. You may default. We don't care. And you're like, wait a minute. Like you're setting people up. Yeah, who cares? Why not? They're going to make their interest while they can. And then when you default on it, they'll just buy it at a cheaper rate and resell it to the next guy in a couple of years, you know? So, I mean, I don't know. I think for me, to look at the word depression or recession, I think for me it makes sense when you say who's affected. Because right now, I would definitely say, are we in a recession? Yes, because there is a group of people that has their spending reduced, they're spending less, maybe because they're making less, or maybe it's just because it's having to go to certain things that they weren't, necessarily spending the last couple of years. I think when you say depression, it's when it's universal. It's the guy that had the good job that is also being affected. When it's 100% of the population that says, I can't afford my lifestyle, therefore I'm reducing it. I think that's when you have a true, depression kind of thing. And I don't see that yet. I definitely see the division of people who have and the people who do not. The people who do not, they're selling everything they can right now. They're trying to pay rent. They're trying to, fix their car. They're trying to get gas money. That's, so is it scary? Yeah, because, a year ago I saw those people flush with cash and spending it like there was no tomorrow. But again, my worry will come when, and it trickled a little bit, but I won't say it's to that level yet, of the people that have the state jobs or the government jobs or the quote unquote good jobs that are saying, hey, I need to sell this. Hey, I can't afford this. I'm selling that boat because I can't afford the payments anymore. When that happens, I think that's when you hit that true depression.
Yeah, and I think, we talked about this a couple months back regarding the sectors of employment that we saw growth in, right? And one of those being government jobs, right? And government jobs are a security because, if you're in corrections, probations, maybe law enforcement, it's very difficult for you to lose that job when there's an increasing demand for it. And now with the administration's demand on the immigration that they're reformed, I wouldn't say reform, but the immigration orders that are out there, more and more folks that are jumping into these areas of corrections or ICE are getting their hands full. Mm-hmm. And right now they have a quota and it looks like, you're out and about. So those jobs have security up until administration says no more, right? And they cut back. And it's a back and forth type of deal, right? And we see that often. But one of the things that we talked about in the last budget workshop, Rohi, and I think you hit it the nail on the head, is we talked about seasonal income, right? And we talked about our March revenues coming in, and more importantly, the sales tax. So the question well, not the question, but the one thing that popped into my head was, well, wait a minute. March seems very closely correlated to tax season. Yeah. So I'm assuming that maybe the reason why you see sales tax revenues up is because people are getting flush with cash. Again, through their tax refunds.
Yeah.
They're spending that money, either buying a car, or you mentioned this very closely related to when the tariffs was going to take place, which was in April. So businesses may be saying, hey, maybe it's best for us to jump on this and buy these things today. But again, that could be an anomaly. We won't know if that projection of sales tax is going to continue.
Yeah.
We'll know when we get the report, right?
Yeah, but and that's again. So that's why, I mean, when I coming into the government side and starting looking at your guys' budgets and the tax.
Your guys, you own it now, bro.
But as I was stepping into it, I was chuckling in the background because I was like, yeah, that's my charts. Like if I go pull up my sales charts, that's my charts. December is great, March and April is great. Everything else is flat or negative, because you have to identify what Madera is. Madera is not a destination location. We're not a vacation location like you would say, like the beach or those. Because I think if you went and you said, let's say we were a coastal area, I think their charts are going to be similar but shifted. For instance, their Decembers are probably terrible because nobody is going to the beach in December. But I would probably say their June and July and August are probably their best months, which is why when you say, Madera's worst month is June, July, and August, because people aren't, they're not spending all their money when the kids are out of school saying, hey, how do I, go buy a gun or go buy whatever. They're hitting the beach and they're spending that money they've been saving all year to go to whatever Disneyland or, whatever fun vacation they have planned. And that tax money is going to those locations. So I think that's why I'm saying you have to take COVID out of the anomaly and say, like, look, that, COVID screwed up those cycles because even we would see, like, we didn't have the traditional seasonal buying. It was just spending and spending and spending on a constant basis. And you just kind of said, yes, things were stacking and stacking, So I think that's why I say pull back 2019, wipe out the last 4 years and kind of say, based off of 2019, what was our growth? Where are we stand now? And be mindful that a lot of that growth is just simply the cost of product. And I think that's where, again, it gets back to scary with the economy and what we say generated tax revenue is if you haven't followed the cost of products are actually coming down in price. So that means, again, if the gun was $500 in 2019 and then all of a sudden it was $1,000 in 2024, but guess what? In 26, because now they're seeing sales slipping, they're starting to reduce what they're charging for it. You're going to have less tax money, because people are only going to buy. Again, I'm just putting it related to the gun industry. If I'm buying 1,000 rounds of ammo, in 2019, I told people that the December 2019, the price of ammo crashed. It was getting down to about $8 a box, just to put some easy numbers. You go fast forward to 2020, 2021, that same box went up to almost $50 a box. Okay, you fast forward to today, prices are coming down dramatically. It's down to $10 a box. So that same person buying the same amount of ammo, there's a huge reduction in what they're spending, and that's why I'm saying I would be very cautious as a city just to say that, look, if the people are buying the same amount, they can only buy so many hamburgers, they can only buy, so many pairs of clothes or pairs of shoes. If the cost of that's coming down, because again, as sales come down, they're going to ease on that cost, you're going to see less tax revenue. It's just inherent. It's just going to happen.
Yeah, no, and it correlates with a lot of the asset classes that we see there, right? I mean, and one of the asset classes that I think you and we talk about is like gold, right? Mm-hmm. And when we look at gold, for example, and again, I don't get tired of saying this over and over. Gold isn't an investment. You're going to have to be rich. Yeah, it's an investment, an indicator of how prices are. And the store of value, right? So again, if you bought gold today, whether it's at $3,000 an ounce, then that's what $3,000 an ounce can buy for that given day. If it goes up next year at $10,000 an ounce, well, that same carton of eggs or gallon of milk, that's the price for it. It's not going to change. It's just a store of value and what it is. It's not a stock where, it can go up or down. Well, it does go up and down, but stocks can have a different value because whereas gold, whatever you could buy that purchase power you had that given day will always be there moving forward.
Sure.
And it's been like that. So, I mean, and that's kind of the way I look at sometimes with budgets and stuff, right? We are facing, I think, some economic crisis that we may see in the future. This isn't to try to scare. I think it's indicators are out there. We see it. You know, we'll be having our budget workshops here moving to the end of June.
Yeah.
And today is another day where we go through our budget expenses. But it's important for you as a resident, if you live in the city of Madera, to pay close attention. You know, what is it that your council is doing? Are we moving on the right direction? Are we trying to keep ourselves at a balanced budget? And that's always our intent. Obviously, we're stewards of your money, and we're making sure that wherever we expend those funds, they're being utilized in the best interest of the city. Now, if there was a year where we can't, there's going to be a reason why. I mean, you're going to see that. You're going to see some major issue that required us to spend more because there was a need. In other cities, I can't speak for them because I don't sit on their council, right? But I'm assuming that they have issues way beyond ours, right? They're bigger cities, bigger expenses, bigger budgets. But with that, Roy, we're coming into the 40 minutes into this show. Anything you'd like to add before we cut it?
I think you kind of said it right. I don't think it's not a scare. It's a preparation. It's just to kind of say, hey, look, if you as a personal, if you're edging or you've been teetering on your expenses, you know, look at the things that you can cut back on. I mean, like, you know, you bought your Starbucks, probably cost you, you know, $3-4.
An arm and a leg.
An arm and a leg. You know, so you have, as an individual where you have control over your own finances, you have to say, how can I, on a meaningful way, scale back a little bit? Like you said, haircuts, you know, does it mean extending a haircut an extra week? Does it mean, you know, instead of having my Starbucks every day, having it 3 times a week, you know, just those simple things to where it's really in the brighter side, it's to say, you know, having a little extra so that maybe you want that boat, right? Maybe you've been you're like, hey, I want to get a boat, and knowing that the boat prices may collapse in the next couple of months, you can get a boat for cheap, right? That's where you monopolize on these experiences, right? Hopefully you're not in the position of having that boat, you're also making payments, you got to take that hit. But I hate to say somebody's going to take that hit, right? I mean, somebody's going to have to take that loss. You just want to be on the other end of it. So I would say, me as the individual, the cautious individual, I would say some of those things that I can live without, that maybe are still haven't quite declined in its value, maybe offload it for now and reevaluate 6 months from now. And maybe you can pick up either the same thing or a better one for less, you know? And those are those simple things that you can do that you say a year from now, maybe I have the same boat or maybe I have a better boat, but I'm in a better position with that boat.
Yeah,
you know?
and I agree with that. I think in many cases, I think, you know, the road of hard knocks will teach you something, right? And if you've experienced it, then you'll know that, hey, maybe walking down this sidewalk where you see that big hole isn't the smartest idea to try to go through it. Maybe you come around it or you could take a different path. And I see that, and you know, a lot of young folks that probably haven't experienced that. They haven't really understood how finance works and how these things can become very, very tight. You know, even buying a home today. I mean, if you're paying anywhere between $3,000 and $4,000 a month in housing expense, I mean, that's a housing expense you have to do every single month that you weren't used to. Not only that, on top of that, there's other maintenance that take place, especially if you've bought an existing home that's been around for 30, 40 years. Yeah. You can expect to have annual maintenance, and you have to factor that in there of how much money I have to put aside so that when that ruptured water leak or that roof or whatever remodeling you want to do, you have to factor that in there. Yeah. And a lot of the times for us, that in itself has gone sideways because we're still driven by the American dream of owning a home, that white picket fence. And I do believe that that's gradually eroded over the last several decades. I think more and more people are finding themselves having to pay much more because that's how, you know, our economy has really kind of forced us to be, right? But to your point, I think that if you become a good student of how the economy works, there may be a downside to it. Well, when is it coming? I've been expecting it. They're supposed to. Everybody talks about the doom and gloom. Well, nobody's talking about doom and gloom here. We're just saying everything is in patterns. One thing I've learned about our economy and our history is that we tend to work in patterns. They may not be exact patterns, but patterns nevertheless. And sometimes those patterns, if you understand them, math is no different. Then they're to your favor, because you may see that, hey, I've seen this before. I don't know if it's deja vu or what, but I've seen this before. It tells me not to walk down this path, but I still do it. Okay, then expect the consequence with it. But if you understand it, then you can say, let me scale back. Well, I've been scaling back for 4 years and I've been missing a lot of these opportunities. Maybe. But again, they're stressing your tolerance level. And it happens. That's why a lot of folks that purchased in 2020, 21, they got a great rate, but they're stressing their levels. And what they're going to do is, well, now that you have this great rate, but you're exhausting all these other credit cards, you need to do something. You need to refinance. Nobody wants to keep that 3%. No investor, let me tell you this, no investor wants to keep a 3% mortgage on their hands. They want the 7% because that guarantees a bigger return. So if I'm an investor that I bought over 1 million of those loans at 3%, and right now the rate's at 7%, I want to get those turned over quickly, no different than the bond market. That's exactly what happens. So they're going to stress you up until you break. And when you break, you're going to refinance to consolidate all your debt. And are you ready for that? Have you prepared for that? And if you didn't, then I'm sorry, you're going to be on the other end where you have no choice but to refinance. Because again, I'm not saying poor management. It just, the economy works a certain way and it works to a certain favor. And sometimes, unfortunately, it's not you. But if you plan accordingly, you may be on the winning end, like you said. So with that, Rohi, we'll leave again with that question. What level of care is too much for an everyday piece of clothing, right? If you have an answer for that, please feel free to share that with us. We're now going to go ahead and exit our show. Thank you again for watching. We ask you to continue to share, subscribe, follow us, as this gives us more and more views that we need to keep this show going.